Perfect. All right. So today, last time I talked about product market fit, and today we're going to talk about how do you run a fundraising process? If you're going to start a company, what does an actual fundraising process look like? So things we're going to answer today are: how do you find a lead investor? How do you negotiate your terms? How do you get the best valuation? Basically, how do you go from, wanting to raise money to actually closing around and creating tension as you go through? So how do you actually create deal tension and get multiple term sheets? That's the best way you're going to get the best terms, the best valuation, the investors that you're looking for. Unfortunately, no one ever really showed me how to do this, so that's what we're hoping to do today. We're going to run through 4 case studies. First, we're going to run through a $10 million Series A. Then we're going to run through a 12.5 million Series A, a $5.8 million seed round, and a $1.6 million pound pre-seed round. So the goal here is to cover the gamut of Series A, seed, and pre-seed, so we can start seeing patterns throughout the process. 2 of these raises were raised at sort of the worst term in the most recent time, if you will, on record of raising money, so that you can see how these the processes we're talking about today work in both good times, but also more importantly in downturns or bad economic times. So it's the right way to raise, and it'll work for you in any market, and that's what we really want to focus on. So today we're going to talk about the 3 things that have to come together if you want to raise your round. Those 3 things are process, running the right process, telling the right story, and backing it all up with the right signal. But it's not really about these things being separate. They all have to come together if you want to raise your round. So your story really impacts the process that you're going to run. You want to make sure that your signal matches the story that you're telling. And something that most founders don't really realize is that diligence on you starts on day one. So how you actually run your process also tells an investor a lot about how you run sales, because fundraising is very much a sales process. And so if you're disorganized, shooting from the hip, always behind the 8 ball, this communicates different signals than you really want to an investor. So we want to focus on the right things. Today, we're going to go deeper into the process side of things. So what does an actual fundraising process look like, so that we can run through actual funnel numbers. And then at the end, we're going to talk about how to bring all of these 3 things, process, story, and signal, together. We're going to cover 4 things. So we're going to talk about my old way that I used to raise money for my company. We're going to talk about the new way I learned how to raise after becoming a VC. We're going to run through real funnel numbers. So we're going to look at each of these 4 rounds, and we're going to look at the different funnel numbers that led to multiple term sheets, so that we can see the patterns across the different rounds. And then, because every fundraise is different, we're going to talk about the different timelines that you can run a fundraise in, and what stays the same and what changes. So, as Sarah said, I'll give a little bit of background on myself. So I started my career as a developer. I was writing code in high school for Nortel Networks way back when. This is sort of just pre.com timeframe. Then I moved into sales for a startup that was pre-revenue. Stayed there until we were just about $100 million in revenue, and public on the Toronto Stock Exchange. This was around the 2006, 2007 timeframe. Then we went into the Great Recession, which is obviously the perfect time to start a company. That's when I started my company, Bearing Media, raised $8 million over a couple of rounds, cut my teeth in all the wrong ways to raise money, but finally got acquired in 2014, where I then ran product as the CTO of the company that acquired my company. We were just over 100 people. And then 3 years later, in 2017, this is when we sold that company to the 4th largest cable company in the US. We were doing addressable television and digital advertising solutions at the time. Then I became an investor for 4 years. So I wanted to see what it's like to be on the other side of the equation. I wanted to see what it was like to actually, what goes on behind closed doors, what it's like to sit in on pitches and what it's like to do diligence on companies, and just what's going on in an investor's mindset. And now I help coach companies on how to fundraise. So I teach them sort of how to bring process, story, and signal together, and how to run and execute an actual fundraising process. So the 4 rounds we're going to go through is Tiny Miles $10 million Series A, on how I help them architect it so that we can so they got 7 term sheets in their Series A. Mile 1, how we helped them get 4 term sheets for their Series A. And Vivid Machines, how we helped Jenny get 2 term sheets for her 5.8 million Series A. Mile 1 and Vivid Machines are the ones that closed this year, sort of in I guess it's April there is when they closed. And so they were ran in this economic time. And then we're also going to cover, I didn't work with Nick, but he had posted on LinkedIn, and his method or his funnel numbers followed sort of the other 3 rounds that I'm going to talk about. He got 3 term sheets, or they got 3 term sheets for their company Trumpet. And it's a pre-seed round. So it sort of rounded out the mix of Series A, seed, and now pre-seed funding. So we can see sort of the entire gamut of early stage investing that we might be going through. So let's start with my old way that I went about fundraising. Now, I used to raise money completely backwards, and worse, I didn't even realize that I was raising money backwards. So this is how I would do it. I'd prepare my round, I'd go out and raise, and then I'd go into search mode. I was treating each of these things like a series of checkboxes, exercises, completely independent of one another. I was trying to figure out what my process was, trying to figure out what my story was, trying to understand what investors were looking at, largely just looking at revenue-based metrics. And then I would go into my preparation mode. So I'd build my pitch deck. I think I was using the Sequoia template or the Guy Kawasaki template at the time, and I was treating it as a series of checkbox exercises. Do I have the right slides, the competition, the market slide, the team slide, etc.? I'd put my data room together, a financial model usually, and a bunch of documents in the data room. Then I'd go talk to a bunch of advisors and ask them, do you think I'm ready? They would give me the thumbs up, say your deck looks good, your financial model looks good, kick off your fundraise. And that's what I'd do. I'd start blind. I would just go out to market and say, I'm fundraising. I'd raise my hand and say, I'm ready to raise. Here's how much money I'd like to raise. Will you lead my round? And then I'd go hard. I heard it somewhere that you had to talk to 50 plus investors. So I talked to 50 plus investors, thought I was really moving the needle. Really what I was actually talking to though was probably 20 or so qualified investors, if I'm being generous. Then I'd get the little standard list of no's. I love what you're doing, but it's early. I love what you're doing, but we'd like to see more traction. Love what you're doing. Don't invest in this space. Don't think the market's big enough. The list goes on and on and on. These are sort of the standard no's that you'll hear that are kind of polite. What I didn't realize, and what Real Ventures did a great job posting about, was that from an investor, maybe usually actually means no. So things that I got that I would get excited about and thought were signal was, love what you're doing. Let me talk to the partnership next week and get their feedback. I'd go back into my team and say, great, we're getting some traction. We're going to soft circle some money. This is fantastic. Or this is great. You've accomplished a lot and you're in the right space at the right time. Now, eventually I'd get this from an investor. Let me know when you find a lead. I'd take that as that you're going to write a check as long as I find a lead investor. So that would amp up our morale again. And we go out, and then this would happen. I'd go into pure search mode. I've got a bunch of soft circled money, or at least I think. And then I go searching for that mysterious lead investor. And when I'd actually find a lead investor, I'd go back to those soft circled money, and 3, 4, 5 months had passed. And they'd start asking the question, are you still raising? Oh, well, we've moved on. We're doing other things now, or let us know. And they'd sort of get shifty again. Now, eventually we did raise. We did raise our seed round and then our Series A, but it was a struggle. And I always thought there had to be a better way, but no one really sort of showed me what that actually looked like. So here's what I learned as a VC. First, real interest moves fast. They'll start saying things like, I want you to speak with my other partner. I want to schedule a follow-up with you in a few days. I want to get access to more information. Can you send me customer references? Can you send me your financial model? These are things that we would say when we got interested in a deal, right? We would start moving as quickly as we could because we liked what we heard or we had seen enough and we want to move to the next steps. The other thing I learned was it's not just about your pitch deck. It's not about just having the right slides. The slides have to tell the right story in the right amount of time. What I didn't realize is an investor spends less than 3 minutes with your deck. More realistically, they spend about 30 seconds with your deck on a first pass. Did something catch their attention? And if so, they're going to go deeper with you on it. An interesting exercise that's going on that I'm seeing a lot more founders do, which I really like, is they're going to write the investment memo for VCs. So when VCs get excited about a deal, they have to pitch it to their partnership and to their investment committee. And typically that involves writing out an investment memo. This is not a business plan. This is a thesis justification document and showing why they believe this is going to be a good investment. It's not about your financial model. It's about the assumptions behind your financial model. An Excel doc is not really good place to do that. So the investment memo is a much better way for you to tell the story that you really want to tell. And then it's about all three of these things coming together, your story, your signal, and for the stage that you're going for. It's about making sure that you have all of this prepped before you go out to market. Then before you actually go out and declare that you're fundraising, just like in a sales process, we wanted to run some discovery. So if you've ever done sales before, it's not a great idea to go into a customer and just start pitching them and just saying, hey, I know you have a problem and I have a solution for you. Let me just start telling you about my solution. It's much better to start asking them questions. What problems do you have? What have you tried before? Start running some discovery so that when you finally pitch your solution, you can do a little bit more of a problem solution fit for them, and you be a lot more targeted in your efforts. Fundraising is exactly the same thing. We need to understand what investors are actually looking for as it relates to our product, as it relates to our market, and as it relates to our company for this given environment that's out right now. Benchmarks change all the time, and it's really important to understand sort of the general benchmarks, but it's really important to understand how they're being viewed through the lens of the current economic climate, because that changes. And each type of investor has a different set of criteria that they're looking for. And so we need to understand what the different types of investors that we're going after are looking for. It's really important to understand the signals that you need to show for your specific stage. So this is part of the discovery process that you want to go through. Then you want to, as you figure out that you are ready, you want to target a big qualified list of investors. And I underline the word qualified there because it's the most important part of it. It's not just blindly running through a list of investors, but a qualified list. So let's look at the funnel numbers that it takes to actually run a fundraising. So how big is the qualified list? And more importantly, how do you actually know that you're on track, right? So like a sales process, we don't just put a bunch of prospects at the top and blast through them as quickly as possible. We want to know that we've got qualified leads in our prospect list. We want to know that we want to do some iteration around who's responding to our offer or to our raise, and make sure that we get more of those qualified investors through the top of it. A typical funnel looks like this. You have your initial target list at the top, you have a first meeting, then you have some follow-up meetings where we're validating the leads. Then we move to diligence. Ideally, we move to term sheets, and then we move to closing afterwards, right? Not complicated, but we want to look at what this actually looks like. The goal and the main criteria is not your top of the funnel. It's generally in the middle of the funnel here. Your goal is to have signal on 35 validated leads. If you can mass 35 validated leads or more that you're having follow-ups with, that you're actively engaging, who are actively interested, the chances of multiple term sheets goes up significantly. The math kind of works out from an sort of average standpoint that you'll get 2 or more term sheets then if they're truly qualified, validated leads, and that you have enough in your pool. And so it's about circling around having a large enough target list so that you can get these 35 validated leads. So here's what Tiny Miles looked like. So theirs was an $8 million Series A. They had 117 on their initial target list. They had 50 first meetings, and that moved to 40 validated leads, ran diligence with 20 of them, got 7 term sheets. Now, I'll point out that the initial target list was 117. They didn't have to go through that full list because they were getting good traction with 40 plus leads. The point here isn't to run the biggest funnel as possible. The point here is to optimize for your time and closing your round. And we had enough validated leads that we were following up with that we were able to sort of move to the next step. And we didn't have to go through the entire 117 connections at the top of the list. Mile 1, 120 in their initial target list, 95 first meetings with 60 follow-ups, 25 moved to diligence, 4 to term sheets. This is the first of our raises that happened this year. And you'll see that the target list was roughly the same, but we had to move to more of the first meetings, and we had to engage with more of the follow-ups to keep moving to diligence and get more term sheets at the bottom. So it took a little bit more effort, but it's similar funnel numbers that start at the top and our conversion rates as we kind of go down the funnel.
Michael, can I stop you here and ask a clarifying question?
Sure.
So when the top of the funnel initial target list you talk about, do they like blast emails to all these numbers, or they email the first 10, first 20, and then when they reach the first meeting 50 they move on? Or like, how does that work? So
it all depends. A lot of these are usually about usually it's split between people you're already connected with, warm introductions, and then cold introductions. So for example, Tiny Mile and both Mile 1, I believe it was roughly 33% people that they were already connected with, hustling for warm introductions, and then the rest were cold outreach. We'll talk about sort of the timelines of how you spread this out over time and when do you do that. We'll get into that in the next section.
Maybe I'm like doing a little bit too much statistical thinking on this, but is it like the response of like did they actually reach out to 117 or 120, or that was the list they curated? And then
So in Tiny Mile's case, they didn't reach out to all 117. In Mile 1's, they did reach out to all 120. So again, it depends on what the conversion rates are happening in the first meeting to follow-ups and how that's going and what timelines you're looking at.
And that kind of speaks the number of term sheets also, like it's reduced even though they had a lot more due diligence. It speaks to as hard as it was this year, but despite of that, they still got 4 term sheets.
Correct. Yeah. So these things still take time, and it's not just a pure numbers game. Vivid Machines, same thing. This time was 130. One thing you'll notice, we're starting to go into earlier stage. So the numbers are going up a little bit. 130, this one was done this year again. So 130, again, they outreached to all 130. 120 of them turned into first meetings, 60 follow-ups, 20 in diligence, 2 term sheets, right? And then Trumpet. Trumpet was a $1.6 million pre-seed. So this is on the pre-seed side. So again, you'll see as we go earlier, the numbers go up higher. We've got 154 on the target list there, 97 first meetings, 80 follow-ups. My understanding from the posts that were done online on this one, the reason why the number's higher there is because it's more of a split between angels and actual VCs in this round. So angels obviously is a lot larger number there. Diligence with 30, and then term sheets were 3 term sheets throughout their process. So if you do any sort of Googling around, this will be sort of the minimum investor funnel you would find. 100 target list at the top, 70 first meetings, roughly half of those would ideally go to follow-ups. A third of those will go to diligence, and then 1 to 2 term sheets. right? So you're looking at basically from the top to the bottom, a 98% no rate and a 2% hit rate, right? Now, this is the minimum investor funnel. If I go back here, you'll notice that all of these are well above the minimum numbers, especially in today's market, right? It's not about, can I get this specific investor over the line? It's about going through the investors and qualifying them to figure out which ones are going to be more likely to say yes in your case. Now, let's talk about timelines. So it's possible to raise in 2 to 3 months, okay? But expect 6 to 9 months or longer, especially in today's economic climate. We'll talk about each of these rounds in a second here. One thing to note is the funnel doesn't change, but the timelines can change. So you're still running the same funnel. It's just if you want to do it in a shorter period of time, you've got to compress it all into that shorter period of time, which means it just takes more of your time. It's more of a burden on you to run this process in a shorter time window. Real Ventures, when they were looking at their portfolio, out of the last 12 companies that in their portfolio that raised a Series A, it took on average about 5.5 months to raise. NFX has a great post that talks about ideally you're going to start building your relationships with VCs 6+ months in advance of raising. And again, these are VCs as you're getting sort of closer to your Series A, obviously. It just maximizes the chances of you getting the ones that you want. This was an interesting one that I'd never really thought about, but makes complete sense. Was as an additional buffer, you should aim to close at least your Series A when you have 6+ months of cash left on the balance sheet, right? Now, this was an eye-opener to me because I would usually only start trying to raise money when I had about 6-7 months of cash left on the balance sheet. And that was sort of my, oh, now I got to step out of the business and try to fundraise so I can get back to focusing in on the business. And I was already just behind the 8 ball. It's one of the reasons why YC suggests that you start thinking about your need to raise money if you're going to raise money when you're 12 months out of runway. They call it avoiding the fatal pinch, because when you get too close, you lose a lot of your negotiating power because you're just too close to the wall. This is a great quote by Alex Hormozi. The longer the runway, the bigger the ask. The longer you build a relationship with an investor, the easier it is to get them over the goal line because people invest in people. So the Myo one took 9+ months, and same with the Vivid Machines, took 9+ months. Remember, these are the ones that closed this year. These are the ones that had multiple term sheets, but it was spread over, or at least the process was spread over 9+ months. This is sort of one of the ideal ways to run a fundraise because you get to spread out a lot of the validation, a lot of your relationship building over time. Your goal is to prep your documents in about a month. We just do work back plans. So your goal is to prep your documents, takes about a month. Take 2 or more months to validate and build relationships with the top of your funnel in your investors, with the goal of having 35 follow-ups before you sort of kick off your fundraise. That's when you raise your hand and say, okay, I've talked to a lot of investors. I understand what they need to see in order to write a lead check. Now I'm ready to run my fundraise. And you kick off your process with a bunch of warm potential lead investors. Run a compressed time raise in a 2-month process. Closing usually takes a month to raise, and you'll have 3 or more months left in cash in the bank. If you add all of that up, that basically adds up to 9+ months of raising. Now, obviously, most of this time doesn't take a lot of your time because you're spreading it out. You're having your meetings spread out over time. Tiny Mile was in that sort of, similar to Real Ventures, was around 6 months to raise their round of financing. The way we approached that fundraising is we had a story. We thought that it was really compelling, but we weren't sure on timing of our raise. So we prepped the documents and then we went out and validated it as quickly as we possibly could. Is this something that investors would resonate with? Turns out it did. We didn't have to run through all of our funnel. Remember that he reached out to 100 or had a target list of 117, but only had first meetings with about 50 investors. What we were trying to do was validate with 3 to 10 investors before we really started out our actual raise process. Once we got through that relatively quickly, then we started the raise process with the rest of the investors. The goal again is to compress that into the shortest period of time, close with 1 month left of take 1 month of closing and have 3+ months of cash left in the bank. And this is a 6 to 9 month process. The goal here is at least go in market and do our discovery to make sure that we have sort of the round we're looking to put together and the story that we're telling fits with what the market is looking to see. And then this one was the most impressive in my mind, is the pre-seed round took 3 months to run and close the process. Now, here's what you have to do in order to run a short process. It's the same funnel numbers, but you need to be pretty confident that you at least meet or exceed benchmarks for the types of investors that you're going after. This one was angels and VCs. So the VCs were in there and they were looking for a lead. They were previously exited founders and they already had 1,500 user wait list set up. Now, if you do a weighted pipeline on that at their average SaaS price, I think that's about $1 million or $1 million or £1 million in terms of users on their wait list. They had the biggest outreach plan. So these are previously exited founders who probably already knew a bunch of investors who made money on their last company, yet they still outreach to the most investors in these 4 examples that I'm giving here. And I believe something like 60% of them were cold outreach for them. So they hustled in order to close this. It took 7 weeks to run this process from cold outreach to commit. So that's just less than 2 months. Took them an extra 3 to 5 weeks, so about a month to close. And at peak, they were having 7 to 9 first meetings a day. So same funnel numbers, just compressed into a smaller time window in order to close the round faster. So it's possible to do. It just takes a lot of effort in a shorter period of time. So running a 2 to 6 month process means you have less than a month to basically prepare. You're not going to do any validation. So you're going to estimate whether you meet or exceed those benchmarks. You're going to have a huge outreach plan. You're going to do that all in basically 2 months. And then it's going to still take you a month to close. And ideally you have 3 months of cash left on the balance sheet. Otherwise you're getting too close to, or you're getting really close to the wire. And if anything slips, or if the VCs want to play any games with you, you're into some dangerous territory. So you want to be careful with that. As a founder, you have one job. Don't run out of money. My recommendation, start as soon as possible if you're going to raise money, right? Too many founders wait until something. They wait until they hit a certain threshold. They wait until they have a certain number of people on their certain traction metrics or whatever. At the very least, start having first meetings with investors. This is not you're actually raising and asking for money, but start having your meetings and getting to know and building those relationships with investors as soon as possible. The best time to plant a tree is 20 years ago, and the second best time to plant a tree is today, right? So we want to start these processes as early as possible because they generally take longer than expected. There's always the corner case that goes faster, but that's not what we want to plan for. Now, a lot of people, when they sort of start seeing these funnel numbers, think this is simply a numbers game. So that's not the takeaway I want you to take away from this, this talk here, that funding isn't a numbers game, right? I met a founder once, a CEO who was brought in because she had a lot of connections into the investor community, had 200 plus connections, first connections into investors, came out of New York and in the financial world, had a huge outreach list, had lots of first meetings, started just plowing through those first meetings as quickly as possible. They were part of an accelerator. They just wanted to sort of go as fast as they possibly could. Didn't really check their materials, but they just weren't getting any follow-ups or any meaningful follow-ups. What happened? They just burnt through about 200 of those investors, 100 plus first meetings. You really only have the one chance to make a first impression when you ask for money. Not when you have that initial meeting with an investor, but if you are asking for money and the investor says no, unless something materially changes, which usually takes 6 to 9+ months for you to be able to come back and have a material change in your business, you'll burn through that list too fast. So it's not about just how big of a list can I make? Can I blast out as many emails as I possibly can, or get as many LinkedIn requests and connections as I possibly can and have as many meetings? It's a game of quality and validation, right? This is just like a sales process. It's not about just getting the biggest prospect list and sending out mass email as much as you can. You want to validate that your process and that your story, that the signal that you're talking about, that they're all lining up and that your process is working. The key are these 2 points: your qualified target list, and are you getting enough validated leads, and are you following up with enough investors? This is your discovery process that acts as a feedback loop for yourself, right? You're going to get a bunch of targeted investors. You're going to start meeting with them. Ideally, you're getting different types of targeted investors at the top, so you can start figuring out which ones are resonating with what you have to say at this stage. It's really hard to change your signal these days, right? It's easy to change your story. So back in the heyday, in the last 3-4 years, when you're fundraising, if you just told a better story, you generally were able to raise more money. And that you can pivot on relatively fast. But if you're missing key signal items, you want to learn what those are as quickly as possible. But those are things that aren't going to change for 3, 6, 9 months. And so you need to figure out what those are and what those gaps are, so that you either have to figure out how you can close those signal gaps or change your list of targeted investors at the top who will understand your story better. And this acts as your feedback loop to figure out, are people moving to the next stage or not? Now, everything we're talking about here today is just part 1, right? This is our deep dive on process. What does an actual process look like? The reason why I wanted to spend the deep dive on it is because, like I said, when I was out fundraising, people all said you have to run a process. You should create FOMO or demand or tension with investors. But no one ever really showed me sort of what the numbers look like and why the funnel numbers worked the way they did and what to focus on. But let's talk about traction. Let's talk about the other 2 parts of it, right? The other misconception people have is that fundraising is all about revenue, right? We kind of, or at least I equate, and I think a lot of founders equate revenue with traction. Now, the $10 million Series A, they had virtually no revenue. They had a little bit of revenue, but for all intents and purposes, they had basically no revenue. The Mile 1 had, for all intents and purposes, for the benchmarks that we're seeing out there today, they had low revenue. Same thing with Vivid Machines, and the pre-seed round here also had no revenue. It's not about traction. It's about investors believing in your ability to hit venture scale. To hammer this point home, I'm going to give you a couple of examples, but first, just think about OpenAI. They raised, I think, $1 billion before they even made any dollar in revenue. Everybody was betting, though, that they would be able to hit and beat and be an incredibly huge company prior to actually raising or having any traction to show for their efforts. And I think they just crossed $1 billion+ in revenue, so they were able to do that. Here's the definition of venture scale. We talked about this on the last presentation that I did, but venture scale is typically, once you hit $1 million in revenue, the goal is that you'll get to $100 million in revenue in 7 to 10 years, ideally faster. The best companies are now going a bit faster, and a common pathway to think about that, at least, is when you hit $1 million in revenue, are you going to triple revenue the next year, triple again the year after that, then double, 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 and then you'll sort of slow down your growth as you're hitting 100 million in revenue there at the top. The key points at the early stage for pre-seed, seed, and Series A is really around this first hit $1 million, then will you be able to triple and then triple again? That's not just growing. That is growing at massive rates and exponentially. Right? And we're talking now about capital efficient growth. So this isn't just throwing money at it. This is true product market fit and being able to hit that sort of inflection point on a hockey stick, right? It's the investors' belief that you will be able to hit that rather than actually having those numbers. And this burns a lot of founders, especially around Series A, when they start thinking about, oh, I will only start talking to VCs when I hit $1 million or $3 million in revenue. But it's not really about the revenue. It's about their growth levers that sit behind that revenue. A good example of you don't actually need the revenue. It's your belief that you're going to do it. And let me be clear, revenue always makes it easier to make this belief, but it's not the one thing, because so many people go to VCs and say, I have the revenue, you should give me money, but that's not the case, right? So Figma is a really good example of this as well. Raised their seed round, their first 3 years in existence, pure R&D. 2015 was their private beta, and their public launch was in 2016, and sort of in the middle there is when they raised their Series A round of financing. I think it was $10-ish million as well. 2017 was the first year they made money, about $700,000 in revenue. And then it took them about 5 years to get to $210 million in revenue. So it took them 5 years to cross well over $100 million in revenue. They raised the Series B, C, and D, and then I think E was up here, and then they got acquired in 2022. So this is 2 years faster than sort of my definition of venture scale that I had previously there. So the seed investors and the Series A investors were making the bet that this company was going to be able to hit venture scale once they started making money. Okay, that's the bet that the investors are making. So that's our goal when we're talking to investor, is to make them believe that we'll be able to hit venture scale. So how do you make them believe? It's really about the story that you're telling and the signal that you have to back that up for your stage. That was what my last talk was really all about, was what's that venture scale growth story? How do you go copy, paste, paste, paste? How do you do capital efficient growth in that $1 to $10 million range? And then we talked about the factory that you need to build to be able to prove that you can actually, what does repeatable and scalable look like? And that talks about all the signals that we need to talk about for our stage that we have, or that we're working on de-risking, and that we have a roadmap to product market fit. So first, thank you. That's sort of closer to the end of my presentation here. My goal out of all of this is that now you understand the right way to run a fundraising process, how to validate a raise, how to run a discovery process, or the fact that you need to run a discovery process, not just blindly go out and raise, that you know how to avoid the wrong ways. So just prepping your materials in a vacuum, running out and just declaring to the world. We know how to do all of this sort of agile, iterative, lean stuff when it comes to product development. Fundraising is no different, right? We can't just do things in a closet and then just go out to the world and expect it all to work. So this is what we're trying to avoid. We understand now a little bit about the minimum investor funnel. The whole goal here was just to open your eyes that it's probably bigger than you expect. For me, this was 2 times what I would used to go think about in terms of fundraising. I would think 20 to 30 to 50 investors, right? I was already behind the game here. I talk to founders all the time. They're like, oh, my fundraising is not going well enough. And I ask them the simple question, how many investors are you following up with? They're like 2 or 3. And they're wondering why they can't get those investors over the goal line. But this is not, we can't control what an investor is going to do. All we can control is the process we run around it. It's the same reason we can't control what a customer will do, which is why we run enterprise sales funnels, because we don't know exactly when every single customer is going to close, or if they are. So we run a process around it to engineer out that risk. We now understand what venture scale looks like. So how to actually show a venture scale story. That was what all the last talk was about, but it's really about getting an investor to believe that you're going to be able to hit the first part of this venture scale story, and that you have the signal for your stage, right? That you have the signal that matches the story that you're trying to tell and the process that you're running. And these 3 things have to come together. Most importantly, it's this discovery loop that you need to be running. You can't just blindly be running through this investor funnel. That you need to be, are you actually getting proper follow-ups, right? We're not talking about maybes that are pretending to be follow-ups, but actually how to do follow-ups. This is the same process that I used to run with Ignacio and his Series A and Tiny Mile, with Charlie and Myo One, and with Jenny with Vivid Machines, and the one that I run typically with, or always with, all the other companies that I help work with. A quote that I love comes from Chris Voss, Never Split the Difference. So it's a book on negotiating. So if you haven't read it, highly recommend reading it, because you'll be negotiating with VCs. Is to prepare, prepare, prepare. When the pressure is on, you don't rise to the occasion, you fall to your highest level of preparation, right? Too many people get to maybe an interested investor and they start asking questions like, how do I negotiate the best terms with this investor? If you only have one at the table, it's really hard to negotiate, because they can always just say no. That's fine for them. You probably need the money, and you're not in a great negotiating position. Your best negotiating position is to prepare in advance and get multiple people to the table and run a process and start early enough so that you can do it. My goal through all of this and everything that I do is to get you prepared faster. I'm happy to talk about the 3-day workshop that I'm running next Monday. Sarah, or
I mean, it's okay if, I really appreciate that you have spent so much time. If you want to plug that in, please do. And then if you have anybody who can take advantage of this workshop, I'm happy this would be the place to hear about it. Go for it.
Okay, so I'll talk about that, and then I can stay for questions if you guys want afterwards. So next Monday, I'll be running a 3-day workshop. Day 1 will be all about process. So how do we actually run this funnel? What do the follow-ups look like? How do we qualify an investor list? How do we validate our leads? How do we work this discovery process? We're going to go and deep dive into that. We just didn't have enough time, obviously, today. Day 2 is all about story. So it's fine to say, here's what my hockey stick graph looks like. Nobody cares about our financial statements. It's all about how do you actually craft that story, and it underpins your entire deck, all the conversations you're going to have with an investor, your data room. So how do we craft that story? What's that go-to-market plan that we actually want to communicate? And how do we articulate our TAM, SAM, and SOM properly to investors? And then day 3 is all about how do we actually run this qualified pipeline here? So what are the benchmarks that we're looking at on each stage? And then how do we go and actually start validating with investors? What are we looking for? What questions do we ask? How do we run as much of this process before we go talk to people? But then also once we're talking to them, what are the things that we're actually looking for our stage, for the story that we're telling? And the whole goal of all of this is to create a roadmap with actionable steps that you can follow to run your fundraise. So every raise is different. There's no, sure that the funnel numbers are the same, but how you actually mechanically run the raise is different. And we need the right checkpoints along the way to know that we're on track. So we can build a roadmap that's customized to you, your story, your fundraise, and what you're going out and market with. So it'll be October 23rd to the 25th, 1 p.m. Eastern time. It's 2 hours a day. For the workshop, the sessions are recorded so that you can have access to those as well. And there's time in each of those sessions that they're live. We can do work and have Q&A. And then with that also, I'm giving you access to all of my training videos on how to do your outreach scripts and roadmaps. So you've got all these documents that you're running through a fundraising process. Your documents, numbers, facts, the story. And it's important to understand when you're supposed to sort of drip these out and how you kind of use these documents to help move your fundraising process along, to go from your initial meeting to your follow-ups and so on and so forth. So this is what Charlie found super important as we ran through his raise. How to also build out your 3-minute why now pitch deck. So I have a very specific pitch deck structure that I like to use. This is how I started working with Jenny's. When she saw Ignacio's deck, she said it was so much better than the Sequoia template that she had was trying to jam her deck into. And then her story started flowing so much better with investors. So you'll get all that training as well. And then how do you actually define product market fit? And that kind of goes into this whole investment memo writing that I was talking about, is what are the assumptions? How are you telling your growth story? This is sort of the bulk of my training, right? There's 2 big things that have to come together for fundraising in any climate: is run the right process and actually understand what product market fit looks like for your company and build out a roadmap towards that so you can start working through those processes. So whether you're raising or not, being able to define product market fit is probably one of the most important things, which is why most people who kind of go through it wish they had gone through it 4 years earlier, because it would have helped them as they had gone through sort of the iterations of their companies. This is all the underpinnings of all the stuff that I worked with Ignacio for the 7 term sheets here, right? When he started, his process was unorganized. The story was terrible. His delivery was bad. But through all of these processes, we were able to bring everything together so that he was able to raise, run his round, his raise, and get the 7 term sheets and close his round. My guarantee on it for you is that you can get access to up to 3 executives throughout this process. I think it's really important to get everybody aligned as early as possible. This is not just fundraising, isn't just the CEO going out and raising. It's important that all the executive team is working towards sort of at least the product market fit component of it, but also understanding sort of what it takes to actually raise and how we're telling the story. I know this is sort of over Zoom and all of that. So pay, sign up, take the first session. If you don't like it after the first session, you can get your money back. Just send me an email, let me know. If you don't find any value out of it, it's a simple, easiest guarantee I can kind of give on that. And then if anybody signs up today, and I'll circle the link with Sarah, they'll get a free one-on-one session with me after the workshop as well. So we can work through your materials, your fundraising plan, your roadmap, whichever ones you guys sort of choose in that session. So it's $397. You get the 3-day live workshops, the outreach scripts, the trainings on your pitch deck, your investment memo, product market fit, access up to 3 executives, money back guarantee, and the free one-on-one session. So the QR code's there. But like I said, I'll have Sarah circulate if you'd like after that.
Thank you, Michael. Really, I appreciate it. And then we have a few minutes. Do we have any questions from the audience? And if anybody has a question, please just unmute yourself and ask. I'll wait for a couple of seconds, and if not, maybe I would ask a couple questions.
Hi, thank you for the presentation. I have a question, 2 questions related. Number 1, about qualified investors. What is your definition of qualified? How do you define qualified for different companies working in different types of products on different verticals? And number 2, you mentioned you in your process, you got advice about your pitch deck. Who are the best people to get advice? Other founders, other VCs that we are not raising money from, industry advisors, a combination? Who we can get the best advice?
Yeah. So the short answer for qualified investors is the ones that will move the fastest, the ones that will get your story the fastest, right? So you don't have to educate them as much. They'll come up to speed a lot faster. One of the whole days on the workshop is dedicated to 2 hours worth of training on sort of how to actually make it work for your specific vertical product and all of that. But the short answer of it is any investor that will understand your business, your model, your market, your team as quickly as possible, so you have less education to do for them. In terms of getting feedback, all of the above. I would start with friendlies and advisors. So day 3, what we talk about is questions to actually ask friendlies and advisors rather than, what do you think of my story? Or what do you think of my pitch deck? What are the questions? How do you actually get good feedback that you can use and action off of to update your materials so that you can kind of move to the next step? VCs that you're not raising from are super helpful because they're actually in market writing checks. That are really, really helpful. The ones I'd be very cautious about are people who've never raised money before, first of all. Second of all, I'd also be careful about founders who have raised a lot of money, but had some sort of like one of those like unicorn products, right? Like if I was building a time machine, I don't think I need a really good deck to sort of sell my time machine. I'd probably give a nice little demo and say, look, you can go back in time, buy a bunch of stocks, make a lot of money today. there's some products out there that where I might think, oh, it was because it was all about my deck, but it was really all about, I just had a really good product, or I had something that was very unique to it. Same thing as if I have sold a company for $1 billion, I probably could have the worst deck in the world and I'd probably be able to raise a lot of money from it, right? So you got to understand sort of where people's feedback's coming from, which is why we spend a lot of time focusing on, don't just ask people, what do you think of my deck? Because you'll get, I don't like this slide. I think your team slide should be up here. And then you get someone else who tells you, I think your team slide should be down here. And you start getting all this conflicting feedback because you're just getting a bunch of very specific advice from very specific opinions, and nobody's right.
Thank you. Just very quick follow-up question on that call.
John, let's see if anybody else has any question in the interest of time. Do we have any other question?
Randeep.
Okay.
Hey, Michael, so I just wanted to invite you to talk about the different kind of advice you get in different stages of your company. Like, for example, in my experience, when we first were raising seed money, a lot of people were talking about a product and we got a lot of conflicting advice from investors, or I suppose the customers, about what we should make our product and what features we should have and so on. But, of course, you want the best advice from customers when you're building a product. And then later, when we were raising Series A, we got all kinds of different kinds of advice, not only about what the product should be, but also the growth story and all that, which is more consistent with what you're talking about the 7-year thing. Could you talk about that and the kind of different advice and who to listen to along the way?
I guess it depends, without going sort of deeper into the background of sort of it, but it depends on who you're trying to raise from. So if investors, well, let me step back. If investors are giving you advice on like, here's well, I think you should have these features, or I think you should have these features, you should figure out whether they align with your vision or not. If investors trying to point you in a different direction, just because they have money doesn't mean they're right? Investors all have anti-portfolios. They're wrong a lot of times. They're human. It's not anything that's bad. You still have to do diligence. Part of the process is you doing diligence on the investor. If the investor doesn't line up with your vision, it's just a glimpse into how bad your board meetings are going to become, right? Because they're going to be at the board meeting and they're going to be like, why are you building that? You should be building this. And you're just going to be at fights all the time. So as much as possible, you want to find the investors, not that just have money, but also obviously align with your vision, how you're thinking about growing, how you're thinking about going to market. That being said, VCs see a lot of things. So listening to their, and rather than just saying, oh, that's terrible advice, at least taking a second pass and thinking about it. Do they see something that I don't see? Is there anything I should change? And if you have conviction that, no, I like the way we're doing things, then it just means it's not a good fit investor for you.
We have question from Marwa. Marwa, would you want to ask it yourself or?
Sure. Just for the sake of time, I'll say it really quickly. If the network for investors is limited and we want to start with the top of the funnel at 100 plus, how do we gather these contacts or build it? Yeah,
so there's a bunch of different ways to do that. Again, that's one of the things we run through in one of the days in the workshop. But this is where you've got to start mining your different connections to who are they, who do you know who's also connected to investors. Lots of, LinkedIn gives us this beautiful view on who else is connected to other people. So how do you actually run through your network? Then how do you build your network in advance? So where are the different ways that you can build up people who would be great, super warm intros into potential investors? The one thing we're trying to generally avoid or doesn't work very well is, hey, Michael, we connected on LinkedIn. We haven't talked really ever. I saw you're connected to so-and-so. Would you flip my deck over to that investor? If I do that, which I probably wouldn't anyways, but even if I did do that, it probably wouldn't be that great of a warm intro because I would forward it off to the investor and say, I know nothing about this company. In fact, I looked at it and wasn't that interesting to me. Do you want to take a look at it? Which is probably why I wouldn't forward it off in the first place. And so it's about how do you get your super warm intros that you can do it. Most people's networks are larger than they think. So it's about mining sort of all of that. That being said, there are a lot of investors out there that are welcoming cold outreaches to them. And it's about doing that process properly and focusing on the right types of investor. Tier 1 investors will always say you need to go through a warm intro, just otherwise they just get too much demand. But there's lots of other investors out there that welcome cold outreach for lots of different reasons. One of the main ones being that it creates a much more diversified and inclusive sort of venture community for people to be able to outreach, that you don't have to always go through the insular and warm intro network. I don't know if that answers your question. Sorry, I'm trying to find you on the screen here.
Okay, thank you so much. Michael, I really want to appreciate that you accepted to come here, and I hope we would have some founders who, if they choose to take advantage of your classes, they will do so. And everybody else, next week we are going to have, I'm going to share more details, but our speaker going to be Monet Stephens, and she has the brilliant background on, she has 5 successful exits, and she has invested as an early stage investor for more than 30 years. So we're going to talk about her experience and what she learned after each exit that helped her invest better. And then after each investment, how did she plan for her startups exits? So I think that would be a very interesting conversation. So looking very much forward to it. Thank you again, Michael. Thank you, everyone.
Thanks, guys.
Have a wonderful rest of the day.